Well, good afternoon, everyone. My name is Stephen Taylor, and on behalf of GSFM and Munro Partners, I'd like to welcome you to today's webinar titled Investment Winners, the US $50 trillion Climate Opportunity. And we thank you for your time tuning in. We hope you enjoy the session today. The format will be, we'll have a number of speakers from Munro just discussing the current thematics within the climate area and the impact on the fund. And we'd love to hear your questions. So please, as we go through the webinar, just send them through, and at the end of the sessions, I'll moderate the questions and we'll try and get some good answers back for you. So with today's session, we've got three speakers that will be speaking. We have Nick Griffin, who many of you know. Nick is the founder and Chief Investment Officer of Munro Partners. We also have James Tsinidis, who also joined Munro in October 2016 and is a co-portfolio manager for the Munro Climate Leaders Fund. And we have Mike Harut, who heads up the ESG function for Munro Partners, which really tries to integrate current ESG thinking and themes into the investment decision-making matrices of the Munro Fund. So we'll hear from Mike in due course as well. And I'd like to hand it over to Nick to start the proceedings, please.
Yeah, thanks very much, Steve. And thanks very much, everyone, for dialing in. Yes, so as Steve said today, it's exciting. We're going to talk about the Munro Climate Change Leaders Fund, which means we're not going to talk about inflation or equity markets at all. We're going to talk about, our specific product here and why we think, this is a great way to invest in what we think is one of the big opportunities in the world, which is how we're going to decarbonize the planet. I'm going to give some very short introductory remarks here and sort of set the stage up for James and Mike as to why we think this is such a good opportunity, a little bit about Munro as a business, and then ultimately I'm going to let Mike talk about some of the initiatives we see out there, and James talk about how the fund's positioned. And please, as Steve said, please throw in as many questions as you want in the Q&A box. This is really your time, and so don't be afraid in typing them into that box there. So very quickly, Munro Partners, as you know, we are your global growth manager. Our goal is to fill the growth bucket within your client's portfolio. We do that with our global products, but we also do that with this satellite product that is the Climate Leaders product. Our tagline is invest in the journey. It is a journey in growth equities. It's going to be a journey in how we decarbonize the planet. James, if you just skip through a few to the summary slide. Look, the business, for those of you who don't know, and I'll keep this very brief, is based here in Melbourne, Australia. We were established in 2016. We run roughly 5 billion in assets under management. And we have 100 million in this climate strategy today, which we launched, just over a year ago today. Most of our products are doing double-digit returns since inception. Second slide, just really quickly, James, is we are a partnership. So we have 24 people at Munro now, more than 11 in the investment team. The business is a partnership, so we own and control our business, roughly 75%. Of the investment team that is working on all of our funds. All of the investment team is working on this climate fund. James and myself co-manage it, but it's an area that we think is very interesting. It's an area that we want to get right up the learning curve as fast as possible, and that's why we launched a standalone product. Just talking about our products, James, on the next slide. Look, most of you are familiar with the Munro Global Growth Fund, which is our absolute return global equities fund. We also run the long-only product, which is our long-only global equities product. Today, I want to be clear, we're going to exclusively talk about the Munro Climate Change Leaders Fund. And you should think of this product as a satellite product. It is by no means a replacement to your global equity allocation. Within the global equity allocation, we are also investing in climate. But we can only make it roughly 20% of a global equities portfolio because we like to run diversified global equities portfolio. But if you, like us, think this is a great opportunity and you want to dial up that bet or scale up that bet a bit, then the Climate Change Leaders Fund is available to you to scale up that bet. If you want to go, say, above the 20% that's in these other strategies. Important things to flag is that means it is slightly higher volatility. We are taking a much longer term view here. And the other important thing to flag about the Climate Leaders Fund, it is a long-only product, so there's no capital protection or short selling in this fund. It is just a very concentrated product that's basically investing in the companies that we think that will help enable the decarbonisation of the planet. Last thing just to flag is all three products today, thanks to the team here at Munro, are now available on the Australian Stock Exchange under the codes you can see below. The Climate Leaders Fund is under the code MCCL. And the simple way I like to think about this, or the simple way I would encourage you to think about this, is if you, like us, think decarbonisation is a great opportunity, you can buy a share in MCCL, and tomorrow you're going to wake up and you're going to own between 15 and 25 companies all around the world that we've done the work on, that we think are best positioned to enable that decarbonisation and ultimately benefit from the opportunity that is decarbonisation. And the day you don't want to hold them anymore, you can just sell MCCL and you don't own those stocks anymore. And that's the best way to think about how we've tried to set this product up for you. And really looking forward to talking to you about it today. So James, that's my very short introductory remarks. I might now skip forward just to talk about why we think this is such a big opportunity and what the fund is, just really quickly. So firstly, so what is the Climate Leaders Fund? And as I said, it's a portfolio of structural climate winners that help enable the decarbonisation of the planet. And the key word there is enable. So I want to be really clear, this is not an ESG product. We do ESG, Mike is on the call today, across all our funds. We integrate ESG in everything we do. But we're not specifically just giving you good ESG stocks here. We're giving you companies that we think will enable that decarbonisation. So you should think of it as either enabler or climate solutions. Every company we're investing in is effectively providing some sort of climate solution, which means as we spend this money to decarbonise the planet, these companies should ultimately win. If you just go to the next slide, James, just to maybe summarise the product really quickly, because I know it's a new product and many people on the call might not be familiar. It is a highly concentrated product. As I said, it's a long-only concentrated product of 15 to 25 positions. We expect it to outperform the index on a 5 to 7 year view, but you should be thinking longer-term time horizons on this. It will be fully invested most of the time. It can only hold up to 10% cash, and it will be currency unhedged. The only other thing I'd flag on this is you should expect the product to run at around a beta of 1.2. We could, and James will touch on this later, build a portfolio that runs at a beta of about 0.3 if we wanted to. There is obviously a large range of companies that are offering technologies that can solve this problem, but we think it's a much more diverse opportunity than that, and we can talk about that. And so we think we can run this product at around 1.2. And as I said, it's about a year old and listed on the exchange. Why did we launch this fund? Why do we think this is such a big opportunity? And I think the key point as to why we launched this fund is we just felt that, having in my lifetime, I was lucky enough as a fund manager to be around at the time that digitalization came along. Digitalization changed the way we worked. It changed the way we thought about the world. It created these amazing big winners like Facebook, Google, Amazon, Microsoft, and the full tech boom that followed it. And that basically ran for 2 decades, from just post or just pre-2000 all the way until quite recently, and will continue to run, but is very well understood now. We think decarbonisation sets up the same way. We have effectively passed a tipping point. That tipping point is shown on this slide, which is quite simply the cost of decarbonising the planet will be cheaper than the cost of not decarbonising the planet. We need to get temperature rise to at a minimum of 1.5 degrees. We're on track for 3 degrees. And ultimately, most countries in the world and most companies in the world have come to the conclusion that they need to do their bit here to bring this down. And it's clearly going to cost a lot of money. And that money ultimately becomes revenue to the companies that can help decarbonise the planet. And so from our point of view, that's the opportunity here. That's what we're trying to do. And on slide 27, I'll just run you through really quickly, and Mike's going to help me here in a bit, as to why we think we reached the tipping point. And we think we reached that tipping point around 2018, 2019. And to be fair, it's not like we just started talking about this a year ago. We've been talking about this for 3 or 4 years now. And we think we reached that tipping point because we saw 3 things happening that ultimately meant that, we were going to embark on this mission to decarbonise the planet. The first and most important well, the first actually, and not the most important, the second is most important, is the country targets. Country targets have been around for a while. country, we are going to vote in elections, and we have recently voted in elections. Climate is an important part of what the electorate cares about. I think the second and the third ones are really what got us over the tipping point, which is thirdly on the right there. We saw more and more investors that care about this, more and more investors that ultimately make this part of their mandate, be it the super funds in Australia or be it BlackRock in the US. But ultimately, what really got us over the line is that one in the middle there, is the corporate targets. Every single company, most companies we know in the world, are now effectively adopting ESG principles in what they do. Within that, they have to focus on the E. So they're generally setting net zero targets. And those net zero targets ultimately mean they have to achieve them. I use this example a lot, but BHP in Australia, one of the biggest companies, if not the biggest, has set a net zero target. They publish a sustainability report. It's over 100 pages long. It's audited by EY, and it basically explains how they're going to get there over the next 30 years. And that involves electrifying trucks. It involves buying renewable energy. It involves, making their buildings 6 stars. And so if BHP is doing it, and Starbucks is doing it, and Amazon's doing it, and IKEA is doing it, and Nestle's doing it, and Ford's doing it, and AstraZeneca's doing it, and Walmart doing it, you sort of get the idea. This is probably going to happen. And so from our point of view, that tipping point is reached. What I'm going to do here is maybe just pass it over to Mike here, because not only have we reached the tipping point, we're actually accelerating from that tipping point. And I'll let Mike go into a bit more detail here across these 3 big tailwinds that we first identified in 2018. And Mike will just explain to you why they're actually now accelerating even faster than what we thought back then.
Yeah, thanks very much, Nick. And James, if you could just go to the next slide, please. So obviously, as Nick mentioned, the first of these tailwinds is around the country targets and really that policy support. So what you can see there on the left-hand side of this chart is, how far we've come, at least in terms of the commitments, really in the last 3 years. So going from 16% of global GDP covered by net zero commitments to now 91%, just ahead of the conference that we've just had in Egypt at the COP. I mean, I think the biggest U-turn probably, if you think of an example of this is, think about the US under the Trump administration when they said, we don't want to be involved in this. We're getting out of the Paris Agreement. Donald Trump doesn't like what he calls windmills. To now Joe Biden, which is, committed the US to 50% to 52% reductions by 2030, and has actually implementing that domestically via the Inflation Reduction Act, which I know James will go into shortly. Maybe just one brief comment on the Inflation Reduction Act. That is a piece of legislation now which does allow 10 plus years of policy support and around $400 billion probably at a minimum of spending to actually achieve that. And I think it's important to remember that this is legislation that's been passed in the US. So to get rid of it, even if Donald Trump does come back, you need all 3 legislative bodies, so the Senate, the House, and the President to effectively repeal it. And there's very little precedent that that's been done in the past. And in fact, many Republican states, such as Florida, actually are quite strong beneficiaries of this. The other thing which I'll just quick plug for is that we've just recorded a podcast for COP27. Our sort of reflections on COP27. So I can answer questions if people have it on this forum, but yes, look out for the podcast that we've just released on that. So that's the first, bit more detail on the countries. And then James, if you go to the next one, clearly the corporates actually in some cases are ahead here. So what these 2 charts show you is voluntary, primarily commitments to the Task Force on Climate-Related Financial Disclosures, which includes metrics and targets that companies have to set. And on the right-hand side, I guess the sort of next iteration in a way of that, which is the Science-Based Targets Initiative, where companies set and then have externally verified their targets to reduce their emissions. And I think it's also important to stress that this isn't just a voluntary, quote-unquote, voluntary piece. It is actually now being implemented by some of these big accounting and other bodies. So, for example, the SEC and IFRS, which is obviously the accounting standard setter, they are actually implementing TCFD as, and that framework into their domestic, into their standards, which then pushes companies further to go down this path. Now, the question is, why are they doing that? Obviously, for many companies, their various stakeholders want them to do so, and their employees and others. But one of the key stakeholders is their investors. So, James, if you go to the next slide, I'll just sort of touch on what we think is one of the key drivers of the corporates leading the charge in some cases, is that their investors, and including investors like us, are engaging with the companies that they invest in on climate change. So on the left-hand side, you can see, this is the priority list, I guess, of ESG investors. What's most important? It's scope 1 and 2 emissions. It's actually also scope 3 emissions. And there are these very well-coordinated initiatives, which are, I think, showing quite a lot of success, like Climate Action 100. So this is something that I was personally involved with in my previous role, working with the superannuation funds in Australia as part of the Australian Council of Superannuation Investors. So essentially, the ACSI members and many of the funds that you'd be familiar with, Australian Super, UniSuper, and this happens on a global scale, they have targets for companies that they want to engage with, such as Rio, BHP, Santos, Woodside, etc. And they have an annual process whereby they continue to engage with those companies. So that is actually one of the things that, again, with various macro moves and various policy or legislative moves, remains effectively constant and has remained constant really now for over 5 years. And in fact, they're now looking to take the next step and become even more forceful in their interactions with the companies. So so with that, I'll pass on back to you to talk about the how this turns into the opportunity.
Yeah, and so thanks, Mike. So ultimately, what we're trying to show you there is since we started talking about this in 2018, and even since we launched the fund a year ago, the tailwinds are actually accelerating. And so what that means is, in our opinion, it's fairly unequivocal that we're going to attempt to decarbonize the planet. And the best thing I can say about attempting to decarbonize the planet is it's probably going to take a lot longer than what most people think. And I'm pretty sure it's going to cost a lot more. But what we produced this slide nearly 4 years ago now. We back then said it's roughly 50 trillion to decarbonize the planet. I've seen estimates now as big as 150 trillion. It's clearly a very diverse opportunity. It covers, just think about that BHP sustainability report. It covers things like renewable energy that you're going to need to power stuff. It covers things like the batteries that are going to need to go in their trucks. It covers things like the energy efficiency that they're going to need to provide in their buildings. It covers the electric cars that they may have to use in their fleets, the buses and trucks, the transmission grids, etc. And so from our point of view, the reason why we like this so much is not only is this like a mega big opportunity or TAM that's going to grow, it's a very diverse one. And then, James, if you just scroll forward, and again, I've shown this slide before, but I'll just remind people, from our point of view, we, having identified this opportunity 4 years ago, now see 4 clear, distinct ways of playing it. And so we've taken that universe and basically said there are 4, reasonably diverse ways of playing the same opportunity. The first on the top left is clean electricity. So that's not just renewable energy, but that's transition fuels. What we've all learned in the last few years is the transition opportunity is, quite frankly, as big as the renewable opportunity. And that's what we put in that clean energy bucket. The second thing we talk about is clean transport. This is where you have Tesla and effectively the whole supply chain, whether it's semiconductor companies, minerals, etc. That is, again, a separate opportunity, but also very large. The third opportunity on the bottom left there is energy efficiency. So that's things like insulation, lighting, heating, ventilation, and cooling equipment, all the things you need to do effectively to create a 6-star building. And the fourth opportunity is circular economy. And these are the companies that are involved in things like recycling, agriculture, producing of carbon credits, packaging, et cetera. And so across those four different areas, you effectively have 4 different areas that are all basically linked to one thing, which is how we're going to decarbonize the planet. But secondly, not one of them should actually be affected by, say, one change in regulation or subsidy regimes in any one country, because they're all being driven by either corporate decisions, government decisions, consumer preferences, etc. And so from that point of view, we feel we get out of that, we can build a reasonably diverse portfolio and one that hopefully benefits from this great structural change that we think is going to occur over the next 20 years. So with that, I'm going to pass over to James, who tells you how the fund's positioned and what some of the big ideas in, and then we're really looking forward to your questions at the end.
Great. Thanks, Nick. Thanks, everyone, for your time and your interest in the fund and also in Munro. We really appreciate it. I'll just quickly touch on a couple of the big thematics at the moment and then sort of tell you about how we're positioned to benefit from that. So the first one the guys sort of already have flagged is the Inflation Reduction Act. Another plug for our podcast series. We've actually done a couple of podcasts on this one, Mike and I, going back sort of a couple of months here. So this sort of happened a few months ago, kind of came out of left field for us, but was obviously a very pleasant surprise for us running a climate fund. So it's a really big piece of legislation. And as we've sort of called the top of the slide here, it's a game-changing event, this US IRA, because it gives 10 years of policy support, which is a change from historically. We've had sort of 2-year rolling credits and things like that. It's very hard for these renewable companies to run a business in that sort of scenario where you're sort of having these very short cycles. Now we have this 10-year plus cycle. The reason the plus is there is because this actually is in place until the US reaches its goals. So if it doesn't reach the goals within 10 years, then it basically keeps on going until they do reach their goals. So I won't touch on all of these, but you can see a lot of these sort of initiatives on the left-hand side within the pie chart are actually, Nick just sort of talked you through the type of places we're investing and the type of companies we're investing in. You can see just from the titles that a lot of these are going to be beneficiaries. So the biggest beneficiary is obviously the clean electricity side, and I'll talk about how we're positioned there in a second. There's obviously stuff for clean vehicles and fuels, manufacturing coming back onto the US, and then building efficiency and things like that as well. So lots of areas to invest in, very diverse sort of potential beneficiaries from this piece of legislation. Just to sort of take a couple of the key ones on the right-hand side here, obviously got some details on the renewable build-out, so that's solar and wind, batteries. A couple of logos there have set to benefit. NextEra, people have probably heard us talk about in the past, biggest developer in the US, renewable developer in the US. You've got Sunrunner, residential installer, solar installer. And then you've got Vestas on the wind turbine side. Next one down, there's always questions about nuclear, and I'm sure that'll come up in Q&A as well, so I won't go through it in too much detail here, but there is a PTC or a production tax credit for nuclear power. That's very beneficial, or that's a huge benefit to one of our holdings there, Constellation Energy. You've got the electric vehicle side. This is the EV tax credit. Then you've got a battery credit on top of this as well for where the batteries and the EVs are basically produced by US manufacturers or within free trade agreement zones. And so that benefits that sort of whole EV OEM side as well as the supply chain as well where applicable. The last one is just with regard to energy efficiency. So this is beneficial for companies in the HVAC space, as Nick mentioned, insulation, lighting and switching and so forth. So a couple of sort of key things we're looking at there and some of the sort of logos that we invest in. Happy to sort of take questions on any of those companies later, but I'll keep rolling through. So this is just a little bit more detail on what we'd expect. And I'm getting to the point here with the companies that we're positioned in that we're actually lifting our weights into to benefit from. But this is just a little bit about sort of how the decarbonisation is going to occur in our view, and where we expect, I suppose, the share gains to come from renewables in particular. So you can see here on the left-hand side in the sort of purple colouring, you can see today's energy mix in the US. Obviously, a lot of coal and natural gas in there, a little bit of nuclear as well, and then sort of about 18% to renewables. We'd expect that to grow over the next sort of 8 years to 50% of the mix. You can see there that natural gas is still a key fuel in 8 years. Nuclear actually holds its share because obviously there's zero carbon in nuclear, and happy to sort of discuss that. You can see obviously the very big shrinkage in coal. The other thing just to bear in mind here is that we would expect electricity demand to increase relatively in a pretty relatively linear manner here over the next sort of 8 years. So we'd expect electricity to take a share of, or sort of part of market share from other fuels. So just think about as you transition from a petrol car to a EV, that's going to put more pressure on the grid. That's going to mean more demand for solar, wind, and actually that grid network EV networks, etc. So we actually expect electricity to take quite a lot of share over the next 8 or so years as well. So even though the actual percentage of that gas, for example, is getting lower, the other thing to bear in mind is that the actual pie itself is larger because it's growing over the next 8 years. So how do we sort of benefit from this in terms of our positioning? In the US specifically, we like NG.Zero Energy. This is a long-term holding for us. It's a very large company, but it is the biggest developer in the US on the renewables side. The other one we like is Constellation, and again, happy to come back in Q&A. This one's a big beneficiary from that nuclear PTC. So that basically guarantees effectively their profitability at a certain level, because in the past they've been more exposed to sort of prevailing electricity prices. So good at the moment for them, because electricity price is obviously high because they've been driven up by nat gas. But obviously the bear case was that those electricity prices would come down, and they would sell for potentially less than what it costs them to generate that nuclear power. With this nuclear PTC, it's basically taken that bear case off the table because we know they're going to be profitable regardless because of that federal support. The other big game-changing event is obviously the war in Ukraine. And so how do we sort of position for this? So Europe's obviously well ahead of the curve here in terms of their decarbonisation goals. They're not new. They've been talking about this for many, many years, and they've really been pushing the rest of the world. Obviously, we've had the war in Ukraine. What does that mean? Does that mean you go back to coal? In the short term, yes, they have been. But in the longer term, they need to have basically increase the political support and policy support for getting off Russian gas and obviously off coal as well. And so they have some policies in place on the right-hand side. You can see here, for example, they've pulled forward the renewables target, the third box down, 40% to 45 by 2030. So they've made a few sort of adjustments here in terms of their policy support and their objectives. In our view, sort of their policies are not quite as good as what we've just seen in the IRA. In the US, the US is very good at using the carrot. So sort of less from our perspective here, but certainly some beneficiaries, companies like RWE, Elfin, Kingspan, etc., still beneficiaries from what's going on in Europe as well, specifically. So sort of pulling all that together, how do we sort of position the fund? No surprise, I showed you that pie chart up here of the IRA. There's a lot here for clean electricity. So our job at Munro is always to follow the money. And so the biggest part of the fund is clean energy. It's pretty intuitive. Got 9 positions there. I mentioned NG.Zero, I mentioned Constellation. Another indicative position is ADST, actually that European company, or a German company. So that's our largest area of interest within this fund, and that's been also the case all year because it is a more stable area of interest as well. These are very mature companies. They are lower growth than sort of the highly sexy sort of EV side, but they also trade at much better multiples, and they're just effectively compounders over time as they build out this renewables infrastructure. They get paid for doing that. Next section down there is circular economy. So this is often overlooked, we think. Got 6 positions here. An indicative position is Waste Management, which is a US trash company, and so happy to go into more detail later in terms of how that plays into the into decarbonisation. Clean transport. We've got 4 stocks here. Everyone knows about Tesla, obviously, but we also invest in a lot of suppliers to Tesla, like OnSemi, which is a really nice EV play as it sort of sells more semiconductor content into EVs over time. And then lastly, energy efficiency. 3 positions here. Schneider Electric is an example. As Nick mentioned, as BHP goes and creates a 6-star building, they get in companies like Schneider, Honeywell, etc., to sort of control the buildings. So it's a simple, easy win and a good revenue opportunity for these type of companies. Also, as Nick sort of set up earlier, within the climate space over the last couple of years, there's obviously been a lot of hot IPOs and sort of a lot of, really sexy stories come to market. We don't really need to invest in all of that. Nick sort of talked about the beta of 3x that like a lot of climate funds run at. We're sort of saying we can run up ours at 1.2. We've been a little bit below that all year because we've had that sort of higher weighting for the clean energy companies that I sort of spoke about. But this is just a little schematic we put up just to show that we're generally invested in for this fund, what we'd consider to be sort of GARP type stocks, growth at a reasonable price, and even some sort of more value sort of, on traditional metrics, sub 10 times EV to EBITDA metrics as well. So There's a lot of different names in here. Happy to sort of talk about any of these as we go through, Steve. I don't know where the questions are, but basically this is the sort of valuation bands that we're looking at. Some of the sort of higher multiple, higher growth stuff down here that they're investing in, but really for the most part, the fund is sort of quite conservatively positioned in terms of valuations, market caps, companies with high profitability, capital return programs, etc. So that's why the fund has sort of been a little bit more stable than maybe some of the sort of high flying sort of climate stocks out there. Just to put this another way, here's the country exposure. Obviously, a lot of US exposure. As I sort of mentioned, the IRA is really a big game changer to us. So a lot of exposure there, but I mean, some of those companies are not necessarily just domestic companies. Top 5 here, Constellation Energy, that's a nuclear stock I talked to you about, NextEra, AEP, similar, American Electric Power. RWE is a German utility going to assist with, obviously, decarbonisation of Europe. And Waste Management is the trash company I spoke to you about as well. Sector exposures down the bottom, as you'd expect with this fund, sort of a higher weight to sort of utilities and industrials as sort of defined by, the gig sectors. But the common thread is that they're all of these companies are involved in decarbonisation. Last slide I'll just quickly show you before we hopefully get on to Q&A. It's just the performance of the fund. Obviously a rough start, sort of launched, as we sort of entered the bear markets of 2022. But I'd just sort of point out here, some of the better recent performance, and that coincides with this IRA effectively. So you've seen quite a large move on the back of the Inflation Reduction Act. Obviously, we had a 10% move, 11% move in July, and then it's sort of built on that since then. So there has been a bit of a turn in these climate stocks. And yeah, I'll sort of just leave it there. Stephen, hand back to you and see where we're at with questions.
Great. Thank you, James. And yes, we do have quite a few questions. Some of them are a little bit similar, but there's one from Tony here around carbon credits. And he's asked, does the fund invest in carbon credits? And I note that there are now ETFs that provide exposure to carbon credits. And just a follow on from that, from another question is, what is our view on voluntary carbon credits as well?
Yeah, okay, I can take that one. So from our point of view, the fund does not invest in carbon credits today. At Munro, we ultimately are growing management teams that are trying to solve big problems. Decarbonisation of the planet is a pretty big problem, and there's a lot of management teams trying to solve it. We can understand the attraction to carbon credits, but just remember that at the end of the day, it's a government scheme that is designed to put a price on carbon. The price in theory goes up all the time, but it's actually economically sensitive. And so in theory, the carbon price has to get to a certain point to force people to decarbonise, but at a certain point, it reaches a peak and then goes all the way back to zero because we have effectively decarbonised. Last thing I just warn people is carbon credits have been around a long time. In Europe, they've been around for nearly 20 years. I've seen them go to zero twice, and they've had to reset the system. So it's a complicated system to run, a bit more complicated than most people give it credit, and often revolves on economic activity. From our point of view, we're looking for sort of 100%, 1,000% opportunities here. And in our experience, just like in digitalization, whether it was Apple or Google before that, that comes, or even Tesla in this opportunity, that comes from backing management teams that are solving big problems. And so we haven't put carbon in. Second part of that was voluntary carbon credits. Yes, voluntary carbon credits is going to be an interesting growth area. Mike might want to chip in with something when it came out of COP. But from our point of view, the best way to think about that is agriculture. Agriculture, is the net beneficiary here because a farmer goes from selling crops, sheep, cows, and then sells fallow land and gets value for it. And so from that point of view, and cropping techniques can ultimately provide carbon sequestration, et cetera. So that's where investments like Nutrien and stuff have a role to play. And that's where we think about agriculture. But that'd be my short answer to those two. And did you want to add anything, Mike?
No, I mean, I think that kind of captured it. I was also going to mention the deer example. But I think, one of the challenges, especially with the voluntary credit market, and this is something that we have encountered ourselves as a business, because we are actually offsetting all of our, well, we actually don't have any scope 1 and 2 emissions, but we are also offsetting our scope 3 emissions. And to find, carbon credits that are actually, first of all, additional in that that they are removing carbon that would otherwise not be removed, that are credible, that are with credible counterparties, remains a challenge. But so yeah, I'd say I think there are still some questions around some of the voluntary carbon credit markets around, do they actually do what it says on the tin, which is reduce the amount of CO2 in the atmosphere through purchasing those credits. So that's probably the only point I had.
Excellent. Thanks, Mike. And it sort of flows on to another question we've got concerning Munro's ESG process and how do you actually implement that in terms of company engagement, and what are the net emissions impacts of these companies?
Yeah, so I'm going to give that one to Mike, but just before he answers it, I'll just say really quickly, this is the ESG process we're going to talk about here is across all our funds, not just the climate fund, and something that we think about a lot. But Mike, I'll let you roll through it.
Yeah, I mean, again, reiterate that point. The way that we think about ESG is exactly the same, and the way that we implement it is exactly the same for all of our funds. I just thought, given the question, we obviously have an integration piece, which is where we embed ESG considerations into our valuation of stocks. But the other kind of key piece here is the engagement, which is, okay, now that we own the stocks, how are we, a responsible steward of the capital that we've, been entrusted by our clients? And so through the actual process of analyzing the companies on ESG, that gives us, the information about what gaps that they, that we think that they have. And that then enables us to have really, we think sort of quite thoughtful and mutually beneficial conversations with these companies. And so the example that I would kind of point to is on the second one on the right-hand side there, which is American Electric Power. So this is a kind of classic utility transition story where historically they were primarily fossil fuels, but they are rapidly retiring their fossil fuel fleet and their coal fleet and moving towards renewables. So American Electric Power actually has the highest coal retirements of any utility in the US. Despite all of that and the good effort that they were making, we did some analysis which indicated that they essentially can go faster. So we engaged with them directly, basically saying, we think that based on some of your own work, the goals that you've set are actually not sufficiently challenging. So they acknowledged our concerns. And then the pleasing thing was a few months later, they made essentially 2 changes to their emission reduction plans. So between now and 2030, they'll essentially go faster. So they're increasing the gradient at which they decarbonize their own fleet, therefore, putting more into their renewables capacity, which is, going beyond that sort of 50% threshold, which we use in this fund. The other thing that they're doing is that they're going to hit net zero faster. So they're not going to hit it by 2050, they're going to hit it by 2045. And so the combined effect of that is, I think something like 130 million tons of CO2 going from one trajectory to the next that is no longer going to be emitted from that effort. Now, clearly, we weren't the only voice talking to American Electric Power, but I think that, presenting a logical case, being a shareholder, can go a long way to getting these companies to improve. So, we're definitely big believers in the engagement side of things. And I should say, too, another quick plug for something which is coming out soon, which is we're publishing our first responsible investment report, which will highlight some case studies, both in terms of engagement and the integration activities that we're doing. So that's on the engagement piece. And I think, Steve, the second part of your question was around the impact. So James, if you go to just slide 47, this is a hard question, to be honest. I mean, there is no standard way we think to necessarily measure the impact of the portfolio companies that we invest in. There are definitely ways to do it in terms of, what proportion of their revenue, et cetera. But one way which we're sort of thinking about is looking at the emissions that the companies have from their operations, which in this slide here is the dark green circle, and comparing that with the emissions that they help their customers avoid, which is really what this fund is actually focused on. So the 209 million tons is the emissions of these companies from how they actually operate versus the 925, which is actually just 4 of the companies that we invest in. So this is not a portfolio weighted activity. It's just literally adding up all of the companies. So really the key takeaway here is just 4 of the companies, which are then listed on the right-hand side of the graph, their products or their activities and what they sell helps avoid many multiples of what they actually emit in creating those products. So, to take the example of Kingspan, they sell insulation, and their products that they sold in 2021 over their lifetime help avoid 193 million tons of CO2. So that's just one way we think about the impact. There are obviously limitations to this. The emissions avoided is still a developing concept. We're not necessarily thinking about the scope 3 emissions here, although the result is basically the same. But I think the key point I just wanted to make is, my view is that these companies are making a positive climate impact. And I think it's quite clear just looking at 4 of them compared to the emissions of all of them. We are thinking about how we can actually measure and demonstrate in a thoughtful and robust way in what's still an evolving space, how the impact that they have essentially. So hopefully that answers the question, Steve.
That's great. Thank you, Mike. We've had a couple of questions, interestingly, around the nuclear side of climate, and questions from John and Mike, and I might just combine them for an answer. The first is more of a macro view, and what's been asked is, can you discuss the risks in relation to nuclear, i.e. long-term management of spent materials, the risk of natural disasters, and geopolitical issues like we're seeing with the nuclear power plants in the Ukraine and Russia. I might start off on that, and then I'll go to the second part, please.
Geez.
Do you want me to have a go at that, Nick?
You can have a go, Mike.
I'll start, and then let me know your thoughts. I mean, clearly from an ESG perspective, this is one of the things that we looked at. So nuclear, I think we've got a slide somewhere that shows it is essentially the lowest carbon fuel, even lower than wind and solar, because you need to in the supply chain of wind and solar, there's burning of fossil fuels to create the wind turbine, the turbine materials, etc. The key point I think to make with Constellation Energy is that they are exclusive. Their nuclear power fleet is exclusively in the US, so it's not based in Japan. It's certainly not based in Ukraine or any other places where we think there might be some risks around that. And we actually did some due diligence around looking at the spent fuel as well. So the US actually has quite robust, policies and approach to nuclear spent fuel. I mean, one interesting kind of data point here is that in terms of the radiation, coal-fired electricity in the US, it actually causes more radiation than nuclear because of the way that the spent fuel is actually handled. I think one of the other things as well to think about with nuclear is it is an extremely energy dense fuel. So the total amount of spent fuel that is generated over time, even from what is a relatively large proportion of their electricity mix, is still it's not like in The Simpsons where there's giant vats of green goo and so forth. It is a solid, first of all, and it's a much smaller amount than certainly than I first had appreciated. So I think yes, there are some risks around nuclear, but this is a company that's exclusively in the US, where we think that the regime to actually handle that waste is quite robust.
Yeah, maybe Steve asked the second part of the question, and I can finish off on Constellation.
Excellent. And it does actually relate to Constellation more directly in terms of roughly what percentage of earnings would be from nuclear as opposed to other sources, and what is their horizon for developing new plants? Would you also see them developing them offshore? How does that play out?
Yep. Okay, James, actually, can you scroll back to the power mix slide and then into the Constellation slide, the one you showed earlier? Yeah, you've got it there. There it is. Perfect. Look, I mean, obviously these are difficult questions around nuclear and ones that we've had to solve ourselves. But I think this picture shows quite clearly that, and the more we've looked at it, the more we've come to the realization you can't solve the Paris Agreement targets. You can't solve 1.5 degrees without keeping your nukes open. The nuclear assets have to stay open because it's such a big part, as you see there at 19%. You have to keep it open to effectively hit the targets. And this is what the world has come around to. And unfortunately, the Germans have come around to it a little bit too late. And so from our point of view, once you've overcome that understanding that nuclear has to be part of the mix, and we're on all of the above to try and solve this problem, then we find Constellation Energy. So if you just scroll to the next slide on Constellation Energy, James. No, sorry, the next one down. Yep. The reality is that anybody who owns nuclear assets today becomes quite valuable because A, they have to incentivize them to keep them open, which they did with the nuclear PTC for 10 years. B, the sites that they have are quite valuable. If you ever want to develop a new nuclear plant, the only place to develop a new nuclear plant in the Western world is next to a current one. And even then, I suspect it's quite unlikely. The third thing that happens is you need that nuclear power to power things like hydrogen. The best hydrogen, it comes from renewable fuels. The largest source of renewable fuels is nuclear. So they get to double dip the subsidies. And the fourth thing that happens, that actually does happen to Constellation, is that if when Microsoft's trying to hit their net zero target, they have to buy a lot of renewable fuel because they use a lot of power or renewable energy. They buy exclusively off Constellation and they pay them a premium for power, which is effectively a commodity, which gives you an idea of where we're at. Specifically, Constellation's revenues, over 90% comes from nuclear. They're exclusively a merchant nuclear fleet operated in the US, spun out of Exelon in February, and you know, was just really lucky and happy to find it at an opportune time while the US were trying to decarbonize. The only other business they have is a couple of natural gas-fired power plants that are these to offset, and obviously a power retail business on top of that. But it's a pure play nuclear company, and we'd love to be able to find some more listed in the developed world. The only other place we can really find them is in Japan, and there's one in the Czech Republic if you really look closely.
That's great, thank you, Nick. Another question here is, we've spoken historically and also today about the circular economy being on our radar. What stocks do we like in that space at the moment?
James, you want to take that one?
Yep, thanks for the question. Okay, so I won't go through all of the slides here, but basically I think everyone knows that we have a problem with trash and basically use of virgin products and not reusing them enough. So that's a little bit about the schematic there. This is just the US in terms of the human activity and basically what we expect in terms of the market to grow at. The companies we like best are actually these companies down the bottom here. So the US trash companies. At the moment, they're not recycling a lot and they're not doing a lot with their landfills and so forth. Basically, the under the radar opportunity here for these companies is to take the trash that they collect on behalf of companies like Coca-Cola, Starbucks, etc., and actually sell them that recycled product back. So they can do that one of two ways. They can make money out of that one or two ways. They can basically sell them back the recycled product, which will trade at a premium to the virgin product and basically capture that sort of commodity spread. That commodity spread might be a bit volatile based on sort of demand and supply. The other way they can do that is they can actually just start charging companies to basically return the recycled product to them, like a fee for service type of thing. So this to us is a new revenue opportunity for these companies. There's already very good companies anyway. It's a very good industry. We're showing you down the bottom there, the big three are 50% of the industry. There's huge network effects with these type of businesses. Disruption is hard because of the density of these networks and so forth. And then on top of that, you have this sort of very large recycle opportunity that doesn't it's just in the infancy today that we would expect to continue on. The other part of these businesses that we really, really like, which we don't think is really in the price, is also renewable natural gas. So waste management, for example, builds its own. So I'll take a step back here. So on a landfill, when you throw away organic material, as people might be aware, all these landfills are sort of lined with plastic. What they can basically do is get gas off that sort of decaying organic material. Historically, they've been doing this for quite a while and then using that gas to power their fleet. What they are actually doing now is basically continuing on that process, but actually refining it to the level where they can actually put it back into the gas pipeline and sell it into the grid effectively. So that's another opportunity. Waste management's actually guided to some revenues, also some EBITDA on this, but they're only doing it on a limited number of their landfill sites at the moment. They actually have 220 landfill sites across the US. So they're only really scratching the surface, and this is real money. This is quite material. We think it's going to take some time to play out. They're not going to roll it out across every landfill site, day one, but they have the technology already because they've been doing it for some time. And we think there's a lot of opportunity for them to continue it. So two very big sort of circular economy angles. To recap, there's the recycling, because we know that way too much gets put into landfill, and then there's the actual gas off the landfill itself. Interestingly, a couple of weeks ago, BP made an acquisition in this space, in the renewable natural gas space. They paid 18 times EV to EBITDA for a company that actually does the renewable natural gas on behalf of other waste management companies that are a little bit smaller than Waste Management. And that's a pretty decent multiple. We think they probably got that asset quite cheap, BP. Waste Management doesn't trade at anything like 18 times EV to EBITDA. So, we think it's a nice opportunity for this company to grow its earnings, but also to basically potentially lead to some re-rating in the stock as well. But that's probably our number one idea in the circular economy, Steve. There's a couple of others. Nick sort of talked about agriculture. There's other names we've historically like in sort of the packaging space as well, recycling, vending machines, etc. But really, waste management, waste connections are the sort of two biggest stocks today, and then sort of a little bit of agriculture. Mike sort of briefly touched on it, Deere, Nutrien, etc. As well in this space. But yeah, it's quite a good space, diverse space. And again, you sort of buy companies that are just trading at market multiples, and they have these sort of under the radar sort of climate characteristics behind them.
Yeah, that's great. Thank you, James. And I'm conscious of time. We do have two more questions that I'll put to the panel, just a quick answer if we could before we wrap everything up. But the first one circles back to some comments I think Nick made around Constellation Energy, and it's from Michael. And he said, can you give some color around how nuclear is renewable? And I think it's interesting, given that part of the previous question was, how do you store all the waste product from nuclear? And how does that sort of feed into it being labelled renewable?
I think we basically answered the question. Look, I understand this is a difficult topic of people. I just make the point that we're very lucky to have Mike on board here at Munro, because we have gone and done the work, and we have gone and looked at this. And from my point of view, I'm a fund manager, right? I'm going to say, I think this is a good opportunity and we're going to invest in it. And then Mike's going to go away and do the work and say, how are they disposing of the waste? Is this renewable, etc.? And I'll just take it back to something I probably haven't mentioned, but I should mention. Remember, the fund is about enabling the decarbonisation of the planet. In our view, a company that enables the decarbonisation of the planet is a company that has more than 50% of its revenues coming from products that help decarbonise the planet within the next 5 years. The nuclear company we've invested in today has 90% of its revenues that help enable the decarbonisation of the planet today. And on top of that, if it moves into hydrogen, like we think it will continue to do more and more to help decarbonise the planet. And so we think it's a good place for our capital. But I understand people might have a different view.
Yeah, just the other thing that I'd add, Steve, is I think the language that we tend to use in terms of the sub-themes is clean energy, not necessarily renewable energy. And here on that slide there, we talk about carbon-free baseload power as opposed to kind of purely just renewables. As Nick said, thematically, what we're interested in is companies that enable decarbonisation. And so, I think yes, there are other ESG types of issues with nuclear energy, absolutely. But in terms of nuclear's capability to produce pretty much low carbon energy, then, I think the graph on the right on that chart shows, that it definitely does have those characteristics. So I think renewable is probably it's not really the word that we would use here in terms of nuclear energy. It's more clean energy and carbon free.
Yeah, that's great. Thank you, Mike.
Steve, we haven't sort of, oh, sorry, I was just going to add, we haven't sort of touched on hydrogen here much. I think we have in previous sort of calls and so forth, but obviously hydrogen is quite key to decarbonising a lot of the industrial sectors, which are going to be hard to sort of decarbonise otherwise. So that hence why Nick sort of mentions the pink hydrogen. Obviously we have green hydrogen as well. But then obviously today it's like green and blue, which is, grey and blue, which is, coal, and natural gas sort of, derived hydrogen. So, green hydrogen, big opportunity, and then pink hydrogen, the opportunity for Constellation. But yeah, we think as an enabler, for both renewables and nuclear of that sort of cleaner hydrogen, that's going to be important as well to decarbonise the planet, because otherwise that's not addressable.
Excellent. Thanks, James. And final question, and conscious of time, but this might lead into a nice conclusion from Nick perhaps as well, because Marshall has asked, would it be fair to classify you as a global climate industrial play encompassing infrastructure, technology and traditional industrial companies that does not have exposure to mining and commodities?
Hi, Marshall. Thanks for the question. The answer is no. No, we do look at commodities. We've owned commodities before. Commodities will, like lithium and copper and nickel, will help enable the decarbonisation of the planet quite simply. And many of those companies would pass the 50% test in terms of whether it's a lithium miner like Albemarle or potentially copper. The reality is the product helps enable the decarbonisation of the planet. So it's something we'll look at. Why aren't there any in there today? Probably slightly a macro view. And secondly, we just haven't found one at the right price yet that we're happy with. A couple of them, Albemarle would be the one that comes to mind first, but we just think it looks a little bit expensive for what it is. But they're definitely not outside the universe. And would you like the conclusion now?
Please do, yes.
Okay, so maybe just to summarise, firstly, to introduce Mike and James, and hopefully you'll hear from them and me, and to look at the podcasts, etc., that they talked about. But if you just scroll to the, you're going to go with that one, okay?
I know, you told me.
Okay, let's go with slide 40. It's a good option. Look, I mean, the reality is I want to be really clear here. This is no different to any other opportunity that we found at Munro Partners in the last 20 years in investing. I talked a lot about finding management teams that are solving big problems. The best example in the last 40 years has been Tesla, and we got through a whole webinar without having to answer a Tesla question, which is a first. But from our point of view, Tesla needed capital to develop an electric car. They got that capital from investors that helped them basically to accelerate the development of an electric car, which ultimately saw them take market share and turn it into one of the biggest companies in the world. So this was a classic win-win-win situation. And it's a reminder of what capital can do to help enable the decarbonisation of the planet. Lastly, maybe, James, if you just go to the website slide, look, we really appreciate your interest, but the reality is we are excited about this opportunity. We're so excited about it. We set up a standalone fund. So if you, like us, believe it's a big opportunity, you can scale up your investments to climate. Our global funds will remain diversified because we think that's what they should be. They should be diversified global equity funds, and they will have exposure to climate, but always no more than 20%. This product is 100% exposed to companies that help enable the decarbonisation of the planet. James showed you the recent performance because of the IRA in the US. Mike talked to you about how things have accelerated since we launched the product. And look, we honestly think we're just getting started here. And so from our point of view, I sincerely looking forward to one or all of us continuing to talk to you for many years about this opportunity, which we think is going to play out across a range of sectors and a range of really interesting conversations like nuclear as we try to think about how we're going to solve this problem, but most importantly, how we're going to benefit from the companies that are going to solve the problem. And that would be my short conclusion, Steve.
Fantastic. Thank you, Nick, and thanks, James and Mike as well. And thank you, everyone, for tuning into the webinar. We hope that you found it very insightful, and we welcome any additional questions subsequently. I would also say that one of the great things being partnered with Munro now for over 6 years with GSFM is that the quality of the material that's available for yourselves and also your clients is first class. I would point you to the Munro YouTube channel and the podcast. There's dozens of topical short to medium length pieces on that, which I think, you know, a lot of your clients who are interested in particularly climate or other structural growth areas, there's plenty there for them. If you do have any questions, please get back to us. Contact your GSFM account manager. We're always happy to help. The other good thing with the climate fund is that it's also available as an ETF. And as Nick mentioned right at the start, you know, it's a great way for clients to easily invest in the top 15 to 25 climate leaders that we think are empowering decarbonisation of the planet. And please stay tuned for the next webinar that we'll probably be doing in the new year now. But as I said before, go to the website. There's heaps of information there. You will get CPD points for listening in today as well. And if you have any other further questions, please just let us know. We're here to help you. So thank you, everyone.